Thank you very much, Maurice, for the generous introduction. It's actually very difficult for me to say that I'm competent enough to speak to business leaders because it's usually a big risk to ask an economist to speak at the beginning of a session like this, especially to business leaders. And that's because usually, if you're at the beginning, if you're the first person speaking in a session like this, you're supposed to be the bearer of good news. I'm not going to pretend that I have entirely good news, but I'm trying to say that I'll have a bit of a sprinkle of what I can call silver linings within the economic terrain. And the silver lining is what usually is referred to in formal senses that the economy is resilient. When you hear a politician or a policymaker talk about the economy being resilient, that tells you that probably there's a small sprinkle of silver linings in whatever is happening. But a basic definition of resilience in an English context and not in an economic context is when you're being beaten from left and right, you're down, you're being kicked, but you're still struggling and moving along. I think I don't know so that's as far as the good news goes. In the next couple of minutes, I'll be able to give you an impression of what it means to be resilient and how that fits within your business ecosystem. I have an understanding that many of you work within the financial ecosystem, and what I'll speak to probably resonates to those who are within the financial ecosystem, even though some of it will be relevant to those who are consumers of financial products and who are in this room. So I'll try to be as inclusive as possible in line with the agenda of today's conversation. So to get us started, I'll basically do 4 things. I'll speak to the global picture. I'll come to the regional picture, and then I'll narrow it to the local picture and speak to the policy dimensions, acknowledging, of course, that, as an economy or even as a continent, we don't operate in isolation. We are not, for those who like classics, the Robinson Crusoe economy, where what you produce is what you eat. We're within a bigger ecosystem of integrated economies. At the global level, of course, we've been talking about multiplicity or confluence of shocks. The most popular one was, of course, COVID-19 and its implications on the global economy and the local economy. And then we moved to the war in Ukraine. And when those two converged, you saw what happened to the global economy. Unfortunately, it looks like shocks continue emerging. The latest one, of course, the crash between Hamas and Israel. And that is going to have huge implications. Those who took the risk of projecting how the global economy is going to perform in the recent past are actually right now crunching numbers to revise the likely outcome of the global economy going forward. So I'll speak to that a bit. Then I'll speak to how that resonates to what you expect in the local environment. In the local environment, of course, I'll spend a bit of time discussing what I call expectations management. And here is really the difference that exists between the official picture and almost cynicism and skepticism that is within the business community and the households. On the one hand, you have, we always have 2 hands. On the one hand, we have the official person almost minimizing the challenges that businesses and households are having right now. So much so that, you may think the official attitude is the mantra of a musician called Bobby McFarlane that says, don't worry, be happy. On the other extreme, of course, is businesses that almost have a distrust. I saw the Kenya National Bureau of Statistics release their second quarter numbers recently, and they said that the economy in the second quarter of 2023 grew by 5.4%. And I could see almost every household and business person laughing that where is that growth coming from. So there's a huge disconnect between the official attitude and the business attitude insofar as growth is concerned. Of course, there's what we can call a policy conundrum. What do you do in such a kind of a circumstance? I'll speak a bit to that. And then, of course, I'll put a spotlight on public debt, because public debt has a huge implication on what you guys are doing, because it can either be a conduit for recovery, or it can be a source for resources being taken away from those who want to use them for purpose of productivity. Of course, even the government is a contributor to productivity, but when the government sucks all the resources that are available, then you have a challenge insofar as growth performance is concerned. And then, of course, I'll give a view on how I see things going forward, what I call an outlook. I'll not want to take a risk of giving you an outlook that is more than 1 year, because anything above 1 year will just be what I can call speculative. Because things are very dynamic and things change pretty fast. So I'll try to motivate what I think, how I see the global economy, the local economy going forward within the next 1 year. I believe that that is really the planning horizon of many businesses. Even if you have those grand visions, I think the planning is within a year. And I've seen businesses actually review or revise their budgets and plans even 3 times within a year because of the dynamism that we are seeing in terms of risks emerging. If I'm able to offer good news within that framework, I'll be very happy. So that's really what I want to take the next 30 minutes or so speaking to. The first is the global picture. I talked about the resilience. A few weeks back, actually almost 2 weeks back, everybody who is anything in the global economic management was gathered in a city in Morocco called Marrakesh, where they were talking about what's going on in the global space, how the global economy is performing, and what it means for purpose of continued prosperity. The IMF, which is usually a very conservative organization in terms of projecting confidence, usually is very shy. They talk about resilience, they talk about possibilities of recovery. But this time around, I think they were a bit blunt because they burned their fingers in the past because of their overly optimistic stances. And the way they describe the global economy is by saying that it's resilient, yes, but it's limping along. So that tells you something. If somebody says that the economy is limping along, it simply means that there's a struggle. One needs to look for opportunity within that struggle and see how you can be part of the solution in terms of recovery. And within that limping along, it's a situation where the global economy's projected growth is actually on the declining trend. Last year, the global economy grew by about 3.5%, declining to 3% this year, as anticipated by the IMF. But the IMF goes further to say that before we see any recovery, it'll probably be dipping. I would be surprised if right now the economists at the IMF have gone back to the drawing board in view of the emerging risks. So these can actually be characterized as what you can call the best case scenario. And in that global picture, the advanced economies are actually the ones that are dragging the global economy down. And it's not surprising because if you recall the last major shock that we had, it was the global financial crisis of 2007 to 2009, when at that point in time the emerging economies, particularly what they call the BRICS, were actually doing very well. The global economy didn't struggle this much, and it was not because the advanced economies were doing well, but it was because the emerging economies were basically uplifting the global economy. Unfortunately now, at that point in time, the emerging markets and developing economies were growing at more than 5%, courtesy of China, India, Brazil, and other economies in the emerging space. But now, actually the struggle is also in these emerging economies. For those who are keen, the Chinese economy has not been doing very well. It has its own unique challenges, especially in the construction and housing sector, which actually has a very deep rooting to the broader economy. Of course, that therefore means that if you have to see any suits of recovery, they probably have to start emerging from what you're calling emerging and developing economies, because as you can see from the picture in front of you, the advanced economies are likely to continue declining before they start recovering. So we are part of that group that is called emerging markets and developing economies. An economy like Kenya is not considered to be an emerging market. I don't know what we're waiting for before we become emerging, but I think we are described as a frontier economy. So I think that tells you, therefore, that no, we are going to be part of the recovery. I have a small we are, but collectively we are going to be part of the global recovery. Bringing it closer, in sub-Saharan Africa, again, the picture for this year is not going to be very good in the sense that we are likely to dip from a rate of growth of 4% last year to 3.3%. with the hope that we can recover to 4% in the course of next year. But I learned a long time ago that hope is not a projection. We have to factor in a number of circumstances that can make us really move from the 3.3% to 4% next year. And why does this matter, especially in the context of Kenya? The Kenyan economy is very, very closely intertwined with what goes on at the global space and what goes on at the regional space. These dots here, if they don't mean anything to you, basically in English, that's what they mean. There's a very close association between how the global economy performs and how the African economy performs. And so long as the global economy is limping the way the IMF has described it, and the way the numbers have given are indicating, then I think we have to start looking at how our recovery position will be in view of what I've just said. The second is that the obvious spillovers that usually come from the fact that we are a small open economy. Many of the African economies, whether you look at them individually or even collectively, fit in what is called the small open economy. A small open economy is one that is a price taker for what it exports and a price taker for what it imports. I can even stretch that definition further and say that a small open economy is basically a policy taker in the sense that we wait for policies to be designed anywhere and we just adapt them. So that therefore tells you that no, the spillovers that come from the geoeconomic fragmentations and now the geopolitical developments that I've already alluded to essentially mean that no, even that recovery from 3.3% to 4% is likely to take quite a bit of context for it to be realized. So that tells you therefore that no, whatever happens globally and whatever happens domestically have a very strong connection. We cannot say, as we used to during Baba Moi's regime, that we're an island of prosperity and peace amongst the turbulence that is going on everywhere. We are very closely intertwined, and therefore what happens globally will have huge implications in what happens domestically. And to give you a flavor of how that global picture now starts filtering in, you just need to look at one parameter, and that's the global levels of inflation. There's a time when the developing countries were having persistent, very high inflations before it started coming down. At that point in time, the advanced economies were essentially struggling with very high inflation. And as we are starting to see, especially from the year 2000, inflation rates have started peaking, and peaking very fast. And this has a number of back factors coming into play, not least the fact that the disruptions that came during COVID had a huge implication insofar as the supply chains, the production patterns and stuff like that. So the supply-leaning kind of inflation has started seeing itself reflected across both the world inflation rates, the advanced economies and the African economies. Just put that aside because it has huge policy implications that I'm going to come to. The bigger one is really the evolution of debt levels across the various African economies. Now, there's a time when the African economies had, especially Sub-Saharan Africa, has huge debts, especially from the multilateral lenders. That was the period around 1990 to around 2000, where the debt levels were very elevated. Then come post-2000 to around 2012, when that rate came down. If you look at these numbers superficially, you may think that the African economies became very good debt managers. They became very, very conservative in the way they approach debt. But if you look at it that way, I think you'll be very wrong. The reason why it came down was simply because many of them were debt forgiven. There was an initiative that was then characterized as the heavily indebted poor country initiative, where if you are poor and you have huge debts, especially with multilateral agencies, you basically go through a policy change program and structural adjustments, and then your debt is forgiven. So the debt came down drastically. Unfortunately, we're not very good in learning, and we're not very good in taking lessons. Many of the countries that were actually forgiven became very clever. They started going aggressive in the international markets to borrow. They started diversifying the avenues from which they can borrow. Let me give you an example. The darlings, in terms of the shining examples of those who did well subsequent to debt forgiveness, were countries such as Ghana. Ghana and what it's going through right now. There's another country that is called Zambia. I'm sure you have business in Zambia's TransUnion. There are some other smaller countries like Chad. What do those three countries have in common? Right now, they are struggling to go through a process of debt forgiveness. So because of that debt forgiveness, countries became extravagant. They started going out, borrowing left, right, and center, with the pretext that no, they're going to deploy those resources in enhancing the capacity of the economies to prosper going forward. But we've now been caught in a trap as the debt level started emerging. That's why now there's a huge conversation around, do we have to go through another round of debt forgiveness? Those of us who watch our president very keenly, he has been very vocal about that in terms of going around the world speaking about how we need to go through a restructuring process. There's even a conversation around why they think the credit rating agencies are essentially unfair to Africa. The only problem I have with that is that no, you only look at unfairness when you're in trouble. And nobody talks about the extravagance that comes at the point of borrowing. I think we have to have a balanced conversation for us to avoid this thing being cyclical. You go through high debts, you're forgiven, you calm down, you become extravagant, and you go continue for like that. And then lastly, on this, what I'm calling the terrible twos, you find yourself in a situation where you have anticipated policy reforms that will make you come out of the debt. The most common one being what they're calling fiscal consolidation, meaning trying to live within your means. But when you have a shock, that becomes very difficult. And that's why in the graph, the graph that is on your extreme, the blue line was basically what was anticipated to be the extent to which the countries will start living within their means. But with the shocks, that was diminished substantially. So that therefore tells us, no, we have a lot of turbulence along the world. And for us to navigate successfully around that, we have to have some ingenuity in terms of our policy positions, and we have to have a sense of candor in terms of how we address the problems that we have, instead of assuming that, no, look, don't worry, everything will be okay. So that is the global picture. Let me now zoom into the domestic picture. I talked about the second quarter GDP numbers, where the growth was about 5.4%, and everybody was like, okay, growth is here with us. But I think that has to be taken in context. If you step back and note for a very long time, you realize that no, whenever our economy has performed at the rate of growth of more than 5%, there's a sense of consistency on a quarter-to-quarter performance. And that's what the picture from 2018 to 2019, before the COVID pandemic came, was. And if you were to extend that back, and I didn't want to take a historical perspective here, you could see probably more or less the same pattern. But you know what happened in 2020. The economy shrunk actually by growing at minus 0.3%, before rebounding to 7.6%. The 7.6% that you're seeing is not a miracle. Essentially, it's because the economy was growing from a very small base, therefore digging itself out of the hole. But then there was what you can call moderation that started happening in subsequent quarters. So from 7.6% to 4.8% to 4.6% speaks to how that moderation is happening. And unless some of these shocks, there's capacity to absorb them, we probably are going to be trapped at the rate of growth of below 5%. That has implications because already I've started seeing planning and forecasting based on a growth rate of more than 5%. We are basically an agroeconomy driven. So with agriculture contributing to about 3% of the economy right now, it just needs to rain for you to see economic growth. There was one time an economist that I wouldn't name quipped that no, people don't eat GDP, and I think he was right. You hear that the economy is growing at 5.5%, and yet people are complaining that they're broke. That tells you that there's a need to reconcile production and consumption. In basic national income accounting, if you measure the amount of maize that you produced, that goes into your GDP growth. But if you've not been paid for the maize that you produced, that GDP does not account for anything to you. So you have to take that in mind when you're looking at these growth numbers. The service sector has actually started rebounding. You can imagine during COVID, we were not gathering like this. Everybody will be seated in their homes right now, struggling with connections to see whether we can hear what I'm saying. But now we are starting to come back. Hotel bookings are looking good. There are some what you can call green shoots that are coming out insofar as that is concerned. But, and this is an important qualification, the proportion of our GDP that comes from the service sector is still very small. That therefore means that no, even if there's quite a bit of a push from that end, we're not going to see that filtering into a resilient growth, where resilience is different from the one that I talked earlier of trying to, say that no, you're being beaten, but you're not dying. So what you need to look at in terms of interpreting these growth numbers, at least at this initial stage, is that we have what you can call a negative output growth. Negative output growth, output gap simply means you're growing, yes, but you're growing well below your potential. That means, therefore, that no, if there's opportunity to push the rate of growth and you start growing at what you can call capacity, then you'll start seeing less and less complaints with regards to whether we really have the power to spend. The second is that all these price changes you are seeing around are driven more by weak supply and not necessarily strong demand. And of course, the scope for new investments is really, really limited. When you're seeing businesses operating at excess capacity, it simply means that no, you're not in demand of new investments. You want to utilize existing capacity fast before you start moving to the next level. So that's really the growth picture. And this simply tells you that no, even if we are seeing elements of growth, that growth requires quite a bit of effort for it to be entrenched and therefore be sustained going forward. That's just one aspect. The second aspect is really what I describe as the tough initial conditions insofar as the policy fine-tuning is concerned, especially now that we are looking to the policymakers to support the economic recovery. I've already talked about the overlapping shocks and the moderation that has happened 2003 and going forward. Now, there are two things that actually come in play in terms of inflationary pressure that everybody's seeing. The first one is really what you can call inflation passing, the pass-through effect of inflation coming from the exchange rate. The exchange rate has really depreciated substantially over the last 2 years. And of course, that comes with the pain of all the imports that you make, especially for necessities. The second is that it also comes at a time when we have oil prices, global oil prices, and the conversation around oil prices is always very controversial, also passing through to inflation. So that's an initial condition that is very difficult to navigate. The third is really what you can call the glaring twin imbalances, the domestic imbalances and external imbalances. The domestic imbalance is simply your fiscal deficit, the difference between how much resources you mobilize and how do you spend those resources. So if you have such an imbalance and your fiscal deficit is anything above 6% of your GDP, then you have a serious domestic imbalance. The external imbalance is your current account position. Current account is not that check that you get from a bank and the account underlying it. It's simply how much resources you earn out of the exports of goods and services and economy vis-a-vis how much you expend for what you export. When the difference is negative, then you have an external imbalance. So when you have those two, those double imbalances, they're not necessarily, people call them twin imbalances or twin deficits. They are not twins as in they are born of the same mother. They come differently, but when they coincide, they have huge implications as far as the economy is concerned. And of course, I've alluded to the negative output gap, where you're growing well below your potential. Those were the initial conditions that you have to have in mind as you start reflecting on how the economy performs going forward. Against that background, then we have what we can call policy fine-tuning. Right now, with all those challenges, we found ourselves going for an IMF program. We actually now have a multiplicity of IMF programs. We have what you can call the extended credit facility and extended loan facility, which basically is a recognition that you have serious balance of payment issues, and therefore you need some support from the IMF to be able to navigate the challenges. And that simply tells you, therefore, that when you go to those programs, they put you on a very narrow jacket in terms of your policy reforms. You have to tighten your belt. You have to ensure that you go into a path of fiscal consolidation, and you have to make sure that you live within your means. Now, the challenge with that is that there's a dilemma, and this dilemma is really manifest. Usually, when you are saying that you're on a fiscal consolidation, it simply means that you're cutting your fiscal deficit by burning the country from both ends. unfortunately, expenditure, and if you look at the budget numbers, expenditure is projected to be increasing. So the avenue for consolidation is only coming from revenue mobilization. And that's where there's an army of KRA. Is KRA one of your... Yeah, there's an army of KRA people who are coming, knocking doors and looking for resources. Actually, the IMF, in an effort of trying to make this look scientific, speak of a revenue-leaning fiscal consolidation. In English, meaning they'll beat every shilling out of you so that you can narrow the fiscal deficit. The dilemma there is really simple. If you have an expansionary fiscal deficit, in some markets they call it an expansionary fiscal deficit, and therefore it has a stimulating effect. In our case, you don't know whether it's neither expansionary nor contractionary, because the spending power of households is actually very squeezed at two levels, the tax levels and inflation as a tax, because then your disposable income shrinks in that regard. So that's a policy dilemma that I think we have to have in mind when you're reflecting about the policy. When it comes to monetary policy, there's also a dilemma in its own sense. Monetary policy is what the central bank does with a view to maintaining macroeconomic stability. They fine-tune that by changing a rate they call the central bank rate, and that central bank rate is operationalized through the market rates and therefore essentially affecting the demand side of things. But remember, I said that much of the inflation that we are seeing arises more from supply challenges as opposed to what you can call a demand side effects. So that makes essentially the monetary policy to be a planned tool. And the challenge that the central bank even has is when much of the problems that are there are not a problem of their causing. There's what you can call the advanced economy central banks. We are talking about the Fed, we are talking about the European Central Bank, we are talking about the Bank of England. They look at things from a domestic standpoint, and they like saying that we are pursuing domestic policy using domestic instruments. But in doing so, they end up having what you can call spillover effects coming to our own markets. So they tighten policy very much, then that has an influence on how resources flow into our economy, and that could actually filter into the foreign exchange market and go back to the challenge that I talked about. So as you can see, the initial conditions are not exactly very promising, but I think we have to give faith to the policy makers in the sense that navigating all these, especially when issues are not of your making, is not going to be an easy thing to do. So that is the initial condition, and this initial condition built into what I call a policy dislocation, or what you can call a conundrum. So let me give you 5 exhibits for what I call a conundrum. The first one, and this is really now putting evidence to some of the things that I've said. We've had a very expansionary fiscal balance. So the red line that you're seeing on your left, when it comes down drastically, it simply tells you your fiscal deficit as a share of GDP has been widening over time. And when that happens, obviously you see your debt accumulating over time. So that's one piece of evidence that fiscal policy has been overly expansionary over the years. Monetary policy, on the other hand, has been fairly accommodative, meaning the central bank, especially during the previous regime, the previous governor's regime, was very keen to ensuring that the interest rate don't go up. Except, of course, during the time of 2016-2019 when we had interest rate controls and monetary policy became almost ineffective. So under such circumstances, one could argue that both monetary and fiscal policy reflect a sense of optimism, essentially being what you can call expansionary and accommodative at the same time. Literature tells us that when you have fiscal policy that is persistently expansionary and monetary policy that is almost persistently accommodative, you incur risk of not keeping some policy scope aside in the event of bad times. When economists want to be scientific, they say that your policy has to be counter-cyclical, meaning during good times you need to be a bit more harsh you need to be a bit more tight on your fiscal expansion, and during good times, you need to be a bit more hard, and during bad times you need to be a bit more accommodative. But we are basically continuously accommodative, and that has its own implications as far as debt accumulation is concerned. The second is really the fact that the short-run rate being continuously at double-digit level has its implications insofar as how it relates to the overall economic growth, and I'll come to that in more detail. But this is one set of evidence that our policy stance that reflects a sense of optimism essentially built into a policy challenging environment. The second is really a picture that many people don't know what to make of. And this is the difference between the average rate at which an economy borrows and the rate at which it grows. The red line, the red area that you're seeing there simply tells you that number is persistently positive. When that number is persistently positive, unlike in advanced countries where that number was negative, and at which point now they can use fiscal policy as a way of supporting economic growth, ours is persistently positive. The dilemma with this is that even if you were to be aggressively ambitious in your fiscal consolidation, it would be very difficult to offset the challenges of debt accumulation that you have. So you continue accumulating debt on account of the fact that your so-called growth-adjusted rate of borrowing is consistently positive and growing. If you look at the numbers right now, and I know there are bankers here, that number is actually growing. So long as growth, the rate at which we grow is sticky, below 4%, as I said, and you're now borrowing at 15, 17%, that number will continue growing. And that has a huge, huge implication insofar as the policy space is concerned going forward. So long as you have a positive growth-adjusted rate of borrowing, aggressive fiscal consolidation may not actually dampen your debt accumulation. So we already have a problem right there. The third is around what I call the domestic and external debt mix. And this is one area where I see a risk that many people don't talk about. If you look at the graph on your left, it basically tells you that there was a point in which if you're borrowing externally more, you're borrowing less domestically. And that has been having a substitution effect where whenever one comes down, the other goes up, until around 2015 when we started having more or less a balance between the two. But there are some risks that actually started emerging prior to 2015. If you look at the red line between January 2006 to around June, July 2016, the rate at which the proportion of debt by government from the external sources was actually gradually coming down, or consistently coming down. At that point in time, the external balance was also widening. Somebody may say that there's something wrong there, because when you're borrowing more externally, your current account ought to be widening. But what is hidden here is the fact that a huge component of external resource inflows into the economy were through the private sector. Remember, this is public debt. You see banks being very aggressive insofar as writing lines of credit from international financial institutions. And that resources coming in simply means that we have a huge component of external exposure that we don't talk about. And that has a way of filtering itself into the currency dynamics that I'll talk about in a short while, that many people don't talk about. There's actually a very recent analysis that was done by the Bank of International Settlement that tells you that if you have such a kind of a situation and you tighten your monetary policy, like many economies are doing right now, including ours, then you dampen what you can call aggregate demand in the economy. So if you have inflation, that inflation is not arising because people are spending more. It's because there's limited supply on the back of very dampened demand. So that is a picture that I think we need to have in mind as a next bit of a policy challenge that we have as an economy right now. The fourth, and this is really linked to what I described earlier as pursuing, in quotes, a domestic objective using domestic instruments. If you look at the graph with a red area, that's a time when we had very low and sticky interest rates. So essentially, the difference between the policy rate and the low end of the market rate was negative. And at that point in time, our currency was a bit more stable, simply because there was portfolio inflows in pursuit of good returns, until we started seeing the tightening of monetary policy by advanced economies. And that led to somewhat a reversal of portfolio flows And that also led to a quick depreciation of the shilling. As you can see, the shilling started going up insofar as the nominal exchange rate is concerned. So that huge correction is a challenge that I think is a bit difficult to address, and especially considering that at some point in time, there was an element of, and people never used to talk this publicly, maybe in dark rooms only. The central bank was essentially pursuing a policy of having a sticky exchange rate, not because it was necessary to contain inflation, but it was appropriately considered to be addressing the fiscal challenges, because external debt that is denominated in hard currency could have really gotten the economy out of what can call sustainability levels if the shilling moved drastically. So essentially the central bank was pursuing or fighting other people's wars. So that is really the dilemma that we see there. And the biggest one, of course, was what I can call assuming that you can repeal the economic rules without necessarily saying it. At some point, we were seeing the expectations, especially on the part of the central bank, to have a stable exchange rate and a stable interest rate at the same time, while you have a widening current account deficit. You cannot have your cake and eat it. If you have a widening current exchange rate, a widening capital account, a widening current account, and an open capital account, and your interest rates are low, your currency must depreciate. You can't have the three of them. If you start seeing your interest rate going up, then maybe that would be a cushioning for the stabilization of the currency. But we didn't see that because the central bank was very keen to have interest rates that are low, and therefore they essentially had to forego one of the tools of stabilizing the currency. So that is the fourth exhibit insofar as the policy challenges at the macro level are concerned. The final exhibit here is around what you can call the crowding out effect. If you take an historical perspective, you can actually see that the economy has been growing over time, except for instances like 2020 and 2008. 2008, we know what happened. We had our political challenges that, tribal clashes and all that. The economy dipped. 2020, we know, but generally the economy has been growing fairly robustly, averagely about 5.3% over that period. But then look at the other side, how private sector credit has been growing. So private sector credit has been on a downward trend, but more so between the period 2016 to 2020. Now, what does that tell you? If your economy is growing and your private sector credit is not vibrant, then that growth must be coming through public expenditure. So a public-led growth model. Can we be able to sustain that? Not at the point where you're accumulating debt. So you're growing while you're accumulating debt. And that simply tells you, therefore, that no, you're basically crowding out the private sector. And that will put you into a trap where, so long as the private sector is not firing with all cylinders, and you're relying on public sector for your growth, then it simply means, therefore, that no, the private sector will not be optimal. You will not get the tax revenues that you want, and therefore you'll continue going to the market to borrow, and therefore enhancing what you can call crowding out effect. So on that backdrop, you have elevated risk profile. Right now, we have the non-performing loans in the banking system close to 15% of the gross loans. That's huge, and it informs the risk attitudes of banks insofar as how they play in this space is concerned. So that is those 5 exhibits tell us, therefore, that for us to navigate and entrench and sustain the rate of growth that we are seeing, there are so many policy things that have to be unlocked. Now, what does it tell you in a nutshell? We have a fiscal monetary policy interaction that portends a conundrum where you actually don't know which is which. I call it the Scottish restroom dilemma. You don't know which is which, you don't know which is the ladies, which is the gents. And this is really a bad situation to find yourself in. But more closely, when you have such a kind of a dilemma, and you see banks being profitable, there's something that is being hidden. It simply tells you 2 things. 1, banks are remaining persistently profitable because they adjust their risk appetite upwards on the back of not the economic fundamentals, but because of responding to policy adjustments. You have your good margins when the interest rates are being tightened. You have an opportunity to lend to government because it has an expansionary fiscal policy. That has implications in the sense that at some point, it will basically boomerang, especially when the non-performing loans continue going up the way they are going. So the build-up of fiscal policy and debts, notwithstanding the consolidation, has huge implications on our debt profile. The challenge thing about debt is that when people talk about debt, you hear a lot, especially from what I call the TV economists, telling you that, oh, you know, our debt to GDP ratio is approaching 60%, 70%. We're in a problem. That is not exactly where the problem is. The problem is actually on the structure of the debt, whereby, you know, you have your debt growing, yes, but the average tenor of that debt is shrinking because you've gone into external commercial borrowings to finance expensive infrastructure, and that tenor is not appropriate for infrastructure spending. And therefore, your commitment in terms of what you pay from time to time is actually increasing over time. So that is one thing. The second is really what you can call contingent liabilities glaring their head now. A long time ago, when IMF used to come for conversations here, they'll talk about, oh, you need to adjust this policy, you need to adjust the other. But right now, a big chunk of time is spent talking about KPLC, talking about KQ, essentially some of those agencies of government that have actually borrowed, with the government being the guarantor, and therefore potentially compounding the debt sustainability issue that we talk about. I'm sure an economy such as South Africa has its own issues with the South African Airways, ESCOM, you know, and those other things. So it's becoming increasingly critical that now we look at the contingent liabilities and what they mean insofar as the whole of this debt situation is concerned. So that's the dilemma, number one. Number two is the market dynamics actually portend a situation where you're seeing the prolonged profitability of banks potentially resulting into what you can call a financial sector risk. So what you see there, what I'm calling the possible Wile Coyote moment, is where, you know, you think you're stable, you're profitable, and all of a sudden, like the road runner being chased by the coyote and turns a corner, you find yourself weighing down. And this is not insofar as financial stability is concerned. It also involves what's happening in the foreign exchange market. Actually, in the foreign exchange market is where we actually now have a Wile Coyote movement, where the shilling was okay, you know, the central bank was managing it until all of a sudden it started doing what I've said there. You know, we don't know how far it's going, but I have my own thoughts, and I won't try to put my voice to a number. But the reality is that, no, if, for instance, we were to, and this is a possibility, we have to make sure that, no, we repair our Eurobond next year, and we will, that will be solving one problem, but also creating another. It will come at a huge cost insofar as, you know, expanding our reserves are concerned. And that will mean that, therefore, the possibility of the currency turning the corner diminishing. So we might find ourselves on the Wile Coyote moment for a while. The other one is really to look at how this has built into the broader risks, the risk profile of the economy. Now we have private sector credit that is the way I've described it. We have the public sector, I mean the service sector that seems to be peaking, but still its potential to drive the economy is constrained. We have an agricultural sector that is actually dependent on whether it rains or not. The joke was at some point that, no, a typical African economy can only grow on account of either good rains or bad statistics. Our statistics are okay, but if the rains are not good, then agriculture is not going to be the driver. We actually have a regime that has less appetite for huge infrastructure projects. So if you think that, no, the public sector-led growth model is going to persist, there you have it. I don't see that appetite right now. We have serious competitiveness issues. There's a report that was just released by the East African Business Council that talks about how our intra-regional trade is constrained more by a lack of competitiveness, expensive energy, dilapidated infrastructure, so that we are not able to trade among ourselves. And we're actually less competitive when you're trading, even with our neighbors. So somebody can produce elsewhere, sell in the region more competitive than you're able to. So there are competitiveness issues there. So what that simply tells you, therefore, that anybody who is projecting a real economic growth of more than 5% is closer to delusional than being realistic. And if you're delusional, then it simply means that there will be a cascading effect. The revenue projections are predicated on a growth rate of more than 5.4%. And therefore, if that doesn't happen, then you go back full cycle. That's one thing. Second is that if you go back full cycle, then you'll have caught yourself in that vicious cycle. And therefore, that means therefore that you'll have a multiplicity of risks. You have instability from a currency standpoint, potential instability from a financial sector standpoint, because there's a threshold beyond which even financial institutions can continue funding government. If a government comes and says, I'll give you 20%, are you going to continue lending it that way? Because if you're a lender and a customer comes to you and says, I'll borrow from you at 30%, are you going to lend to that person? Because potentially that's somebody who's going to likely find himself or herself in a dead and sustainable situation. So the multiplicity of those, what I call volatility dimensions, is in a way pushing us to making volatility great again. And I don't think that's a place that we want to be. My final slide is really around the issue of inclusivity. All that picture of, growth continuously, we have an inclusive society, and I'm happy Maurice talked about the strides that we made around financial inclusion. They have to be seen in context, in the sense that, if you have an economy that's growing and every household is complaining, then that growth is not inclusive. That's a simple thing. If we have a financial inclusion agenda, and there are so many studies that are now emerging that confirm the fact that yes, we are being, access to finance is growing over time. And that's what some of my colleagues do in terms of tracking what you can call finance, access to finance, the so-called FinAccess surveys. But there's a huge disconnect between access and enhanced usage of financial services. And that's probably why, organizations such as TransUnion are spending a lot of time trying to see how they can bridge that gap between access and enhanced usage. So we still have a very unequal and an inclusive kind of growth, both in the financial sector consumption and also in growth generally. And that therefore means that the challenges are even more obvious when you have shocks. And whenever you have a shock, society becomes more unequal. And I think those who are privileged then to almost stand a blind eye to that lack of inclusivity. And that is why I find it profound that, Leo Tolstoy, I don't know whether anybody knows Leo Tolstoy. This is a Russian author, 1877, sorry. Ending up presentation with a quote from a Russian author is interesting. All happy families resemble one another, but each unhappy family is unhappy in its own way. So if you have to start thinking about inclusivity, both from a growth standpoint and from a financial inclusion standpoint, then you probably have to start seeing how we can move those who are unhappy in their own ways to those who are collectively happy, like the happy families who resemble one another. Thank you.